Hello learners. So today we are going to discuss another important topic in the financial management, working capital management, which is a fundamental concept in financial management that plays a crucial role in the operational success and financial stability of a business. It represents the short-term assets and liabilities of a company and is vital for maintaining smooth day-to-day business activity. The effective management of working capital ensures that an organization can meet its short-term as well as long-term obligations efficiently. Moving into the definition of the working capital. Now, what is working capital? Working capital is defined as the difference between current assets and current liabilities. What are the current assets? Current assets which include cash, accounts receivable, inventory, short-term investments, and other assets that are expected to be converted into cash within a year. The current liabilities, which includes accounts payable, short-term debt due within a year. Now, we look into the different types of working capital. We have different types of working capital. First one which talks about the gross working capital, which focuses on the investment short net working capital, current liability. Sometimes we may call it as fixed working capital, which means the minimum level of working capital required to maintain the business operations. Temporary working capital, which is also called as variable working capital, which means the extra working capital required to meet seasonal or cyclical fluctuations in business operations. Variable working capital varies with the changes in the business activity levels. The four important types of working capital. Now we look into the importance of the working capital. The first importance is working capital ensures the liquidity. Sufficient working capital enables a firm to meet its short-term obligations like paying suppliers, salaries, and other utilities. Another importance, smooth business operation. If we want to maintain an uninterrupted flow of production and sales by ensuring timely procurement of raw materials and inventory. It also supports creditworthiness, where companies with healthy working capital are viewed as creditworthy by banks and financial institutions. It improves profitability because efficient working capital management reduces the borrowing cost and enhances the firm's profitability, which enables the growth. So adequate working capital facilitates business expansion and enables the firms to take advantage of growth opportunities. Now, understanding working capital cycle are also called as operating cycle, which means it refers to the time duration required to convert current assets into cash easily. It involves purchase of raw materials, production process, sale of finished goods, collection of receipts. Here, one important point that we need to observe: the longer the cycle, the more working capital is required. So, efficient management aims to reduce the cycle length and free up the cash. Now, moving to the various factors affecting the working capital. Because working capital refers to the capital required for the day-to-day operations of the business. It is the difference between a firm's current assets and current liabilities, and also a crucial indicator of a company's short-term financial health and operational efficiency. The efficient management of working capital ensures that a firm can meet its short-term obligations and continue its operations smoothly. So, the following factors, if you observe, we have certain factors like nature of business, dividend policy, seasonal variation. Few key factors which are affecting the working. How? Now, if we observe the characteristics, is there any difference? Like when we look at the characteristics or factors which are influencing the working capital, more or less, these factors as well as the characters, more or less very similar. So let us understand what is this, how this factor is going to influence the working capital. Nature of the business. So here we have different types of businesses. Some businesses are retail and some businesses need working capital because those businesses might have hold large inventories and they offer credit to customers. When we observe the manufacturing companies, they also require moderate to high working capital depending on their production as well as inventory levels. When it comes to the service industries, usually they require less working capital due to the lower inventory and receivable. Another important factor is the business side. If we observe during expansion or boom period, Businesses grow rapidly, and when businesses grow rapidly, they require more investment in inventory, and they require more investment in reserve. What will happen? Working capital needs requirement will increase. Suppose in the recession period, demand and sales fall, reducing the need for inventory and receivables, which lowers the working capital required. Another factor, manufacturing cycle, or sometimes we refer to production cycle. Here also, if we have the longer production cycle, then more funds are required in the form of work in progress inventory. So higher working capital needs will be there. But simple terms, longer the production cycle, higher the working capital. Shorter the production cycle, and the shorter the requirement of the working capital. So this depends on the type of the company, on the type of the business, on the type of the nature of the business. Even when it comes to the credit policy, credit terms to customers, it increases the amounts receivable and also increases the working capital requirements. Suppose if a firm receives generous credit from suppliers, it can delay the payments, reduce the need for the working capital. Inventory policy now we will look at into the another important factor, inventory policy. Businesses which are maintaining large inventories, because sometimes firms due to bulk purchasing, irregular supply, or due to customer demand, they need more working capital. Efficient inventory management, which reduces the amount of capital tied up in stock, decreasing the working capital requirements. Another factor, operating efficiency. Companies that use resources efficiently can convert inventory into sales and receivables into cash quickly. Suppose due to the poor internal operations, it delays processes, increase the working capital need to cover inefficiency. Expansion plans. Suppose if a firm is growing, and then they will be having more requirement for the working capital, which also increases the levels of production, inventory, and receivables. Availability of the raw materials. When it comes to the availability, suppose if raw materials are easily and regularly available, the firm can keep up low inventory, which reduces the working capital. Suppose if seasonal or irregular supply is there, then definitely the firms has to maintain the stock, which will have an impact on the requirement of the working capital. So, if you look at the terms of purchases and sales also, sometimes company enjoys credit from the supplier. If it is operating with the less working capital, however, cash sales reduces the receivables and working capital, while credit sales increases the receivables and requirement for the working capital also will increase. Competition is another important factor which is affecting, because high competition sometimes may compel the firms to offer longer credit periods, which will increase the working capital requirement. Less competition enables the tighter credit and inventory control, and which reduces the working capital requirements. Inflation, another important factor, which increases the cost of raw materials and labor, which increases the amount of working capital. So businesses need more funds to maintain similar inventory levels or expenses if they want to meet the expenses, especially in the inflationary time. Seasonal variations, because there are certain businesses which are seasonal in nature, like agriculture, ice cream, the demand, which leads to the variation in the requirements of the working capital also. Profitability and earnings. High profitable firms generate internal cash flows, reducing dependence on external working capital finance. So firms with the lower profitability may need more external funding to meet the working capital requirements. So the last and the most important factor is the dividend policy. Suppose the firms are having liberal dividend policy, those companies, they retain less profit. Leaving fewer internal funds for the working capital. Firms that are retain more earnings may have more internal funds available to finance working capital. So I just manage it, then it can kill you.